You're watching IRONWORTH Trading. I'm Coach Price, and this is not financial advice. This is for educational purposes only. I've been going for a while, y'all. My Discord got hacked. TikTok been shadow banning me. That's right. So we're gonna switch it up a little bit because ain't one monkey don't stop no show. Two monkeys ain't gonna stop them either, though, right? Now, something happened that changed everything about how you should position your money. I'm gonna walk y'all through this so that y'all can understand not just what happened, but why it happened and what you're going to do about it. All right, yesterday morning, Federal Reserve Chair Jerome Warsh, not Jerome Powell, Warsh, Mr. Warsh now, right? He gave his first major policy speech since taking over the Fed, and the market took it pretty hard. The Nasdaq fell over 1%. The S&P 500 dropped less than, actually over 1% too. The Dow fell less than 1%, 0.98%. Growth stocks got absolutely crushed. People started panicking. They started selling. They started running for the hills, right? But what I paid attention to is the fact that unprofitable growth stocks was getting destroyed. The chip stocks, the ones that are already making money, they actually rallied. Broadcom up over 4%, Micron up 3.8%, ASML 3.54%, and Applied Materials up 4.35%. We even got Intel up over 5% right now in the overnight market. So you have a market where half of the stocks is getting crushed, half are rallying. That's not a crash. That's repricing. Okay. Basically, money is flowing out of one category of stocks and flowing into another category. And that repricing is one of the biggest trading opportunities that we are going to see all year. But most people don't understand that. You see, most people, they see the market down and they panic. They think everything's bad. I should sell everything. They don't see the structure. They don't see where the money is flowing, and that is why they lose money. All right. And first of all, go watch my video on unrealized gains versus realized gains, so that you can understand that much. That's a whole nother topic. But yeah, by the end of the stream, you will understand exactly what Warsh did, why he did it, and what it means to different categories of stocks, and how you're going to position your money to make money from this shift. If not, you will hope it gets better. Okay. But yeah, to actively profit from where the money is flowing right now, you should pay attention. This is practical. This is how you build wealth, ladies and gentlemen. All right, so we will talk about what just happened. Let's talk about what just happened. Let me walk you through what happened and why it matters, all right? Because I know a lot of y'all don't care, but I'm explaining to you why it matters. So, for the last 6 months, the financial media has been hyping one thing. They've been talking about how the Feds is going to cut rates soon. And why do we care as investors, right? We've been betting on it. A lot of traders have been pricing this in. Okay. So the assumption was that Jerome Powell's he's done raising the rates. Now we are going to ease. Interest rates are going to go down. Cheap money is coming back. That type of bet drove money into a lot of unprofitable growth stocks. But why? Why, face that? No, for real though, why? Because unprofitable growth companies need cheap money to stay alive. They're burning cash, they're not profitable. They betting on future growth, but future growth only works if you have cheap capital to invest in that growth. So as long as rates was low, or people expected them to go lower, a lot of those companies that was unprofitable to begin with became attractive, right? But yesterday, the new chair, Warsh, he shut that shit down. Not gently, but completely, right? He said, we are not cutting rates. The rates are staying at 3.50 to 3.75%. We are going to hold here. We're going to hold here as long as inflation is above our 2% target, and inflation is still running hot. So we talking months, maybe even a year or more. Now I want y'all to think about what that means, okay? Because I know some of y'all don't know, but we're going to explain. The entire thesis that the investors, including you and I, that we've been betting on just got blown up. That's right. The assumption that cheap money is coming, gone. So the hope that unprofitable companies would be bailed out by larger rates, gone. Right? And Warsh didn't just say the rates are staying high. He shifted the entire tone. He moved the Fed from dovish, which means, let's say, supporting the economy, accommodative, right, to neutral, to tight, which means we're not trying to help anymore. We focused on fighting inflation. The economy is stronger than expected. Productivity is strong. Capital investment is strong. We don't need to ease shit. That's how they feel. So that language shift matters because it changes expectations. When War says the company, or not the company, the economy is strong, what that really means is unemployment is fine, growth is fine, we don't need to help. And when you don't need to help the economy, you stay hawkish on rates. You can keep the rates high so that you can fight inflation. So the mechanism of what happened in the market, the investors heard that and said, okay, cheap money is off the table for a long time. So the money immediately flowed out of the unprofitable growth stocks, the ones betting on the future growth that requires cheap money, and they flowed into profitable stocks, the ones that's making money right now. Right? Who making money right now? Why would the money flow there? Put in the comment section why you think the money will flow there. But when the rates are high, a lot of profitable companies that generate cash today are worth more than the companies betting on profits tomorrow. You understand what I'm saying? Think about it. Think about it economically. Like if you could buy a bond earning 4% and it ain't got no risk on it, why would you buy an unprofitable growth company that got a shit ton of risk betting on profits in the next 5 years? You just wouldn't do that. You see what I'm saying? You're going to take the safe 4%. I mean, if you're smart. So unprofitable companies have to get cheaper in order for them to attract buyers. Their stock prices fall. But profitable companies, they benefit. Why? Because the cash that they making today is more valuable when the interest rates are high as they are right now. It's like your saving account earning more interest, right? The cash is worth more. Chip companies specifically benefit because they're not just profitable. They have a moat, a protective wall around their business. So when the rates are high and unprofitable companies can't get funding, they can't build the manufacturing capacity to compete with chip companies. They can't invest, right, in R&D to catch up. Chip companies win by default. So what we are watching is not a crash. We are watching a repricing. Like I said, the money is leaving one bucket and going into another, and that is where the opportunity is. Right? Well, let's talk about it. That's where the opportunity is. I want to translate this into what it actually means to your portfolio, because talking about Fed policy is academic, but what matters to y'all is your money, right? So let me teach you how company valuations work, because this is the foundation of everything. So you got Wall Street, and they value companies using something called a discounted cash flow. And this is how it works. A company generates cash today, but the company also promises to generate cash in the future. So you take all the future cash flows, you add them up, and then you discount them back to today's value. The discount rate is based on interest rates. Let me help you. Let me help you understand what I'm saying. So imagine you lend me $1,000 today. Yeah. Let's say you lend me $1,000 today, but I promise to pay you back $2,000 in 5 years. Is that a good deal? Well, it depends on the interest rates, right? So if the interest rates are 1%, then $2,000 in 5 years is worth about $20 less than that, like $1,980 today. That's a good deal. But if the interest rates are 5%, then $2,000 in 5 years is only worth about $1,500 today. So that's a bad deal. The higher the interest rates, the less future money is worth today. That's the fundamental math. Okay, rewind this video if you got to. Listen to that again. Get it in your head. I want you to apply this to stocks. An unprofitable company promised to be profitable in the future. maybe in 3 years, maybe in 5 years, hell, maybe in 10. Investors value that future profit by discounting it back to today. When the interest rates are low, that future profit is worth a lot today. But when the interest rates go up, that future profit is worth less today. So the stock price falls. Okay? But a profitable company generating cash today is not affected the same way. The cash is real. It's happening now, right? The interest rate doesn't erase existing profits. So profitable companies are insulated from interest rate changes. It's just simple math. That's the core of what happened this week so far. So the interest rates jumped in expectations. The discount rate on future profits went up. Unprofitable companies' valuations got smushed or crushed, right? And the profitable companies held steady. So what this means for you specifically, if you own any unprofitable growth stocks, you're fighting gravity. These companies need to become profitable. That means the company that you are investing in needs to be making money faster than they are, than they currently on track to do so. And they need to do it with higher rates. They have less capital available to accelerate that timeline. Some of them gonna make it, some of them won't. Don't be caught up on the wrong side of the field. You feel me? But the trend is headwind, not tailwind. So if you own profitable companies or you want to buy companies that are profitable, then you're aligned with the environment. You're flowing with the money. You're on the right side of the repricing. Okay, so I'm going to give you a concrete example. Let's look at Tesla. We know that this is a company that's profitable and they're also growing. When the rates were low, Tesla was worth a lot because people was pricing in years of future growth. But Tesla's future growth still depends on Tesla being disciplined and actually executing. And now that the rates are high, people are discounting that future growth more heavily. So Tesla's stock price is lower, but the business is still generating profit today. So Tesla is in a different category than an unprofitable company versus Rivian or some other unprofitable electric vehicle startup, right? Electric vehicle company that just came out that's not really making no money. So these companies are losing money. They need capital to build factories and develop vehicles. With low rates, that capital was available. With high rates, it's not. That's a direct headwind to their business, not a tailwind. You with me? I've been looking at AWS, Amazon Web Services, right? They are building data centers like no other in the Midwest. This is going to be like the new Silicon Valley for AI. But yeah, AWS, Amazon Web Services is interesting because cloud computing is what we call secular growth. It's not dependent on rates. It's dependent on the fundamental shift of companies moving to cloud infrastructure. Whether rates are high or low, companies still need to modernize their IT. They still need cloud services. So AWS is insulated from the interest rate cycles because it's driven by structural shifts in business, not by capital availability. Also, Coinbase is another one. Coinbase is interesting for a different reason, right? So we know that you can buy and sell crypto. It's a cryptocurrency exchange. That's what Coinbase is for the most part. But they doing some other shit now. But yeah, it's profitable in good times, but Coinbase's profitability swings it comes and goes with crypto prices. You see what I'm saying? So when crypto is attractive, Coinbase looking attractive. When people are scared about inflation and currency debasement, it's another thing. It's looking like a place for money to go to, right? When the Feds is being hawkish like Warsh is right now, some people actually see that as a sign that they should move money into crypto as a hedge. So him being hawkish could actually drive people toward, back toward Bitcoin or crypto in general and Coinbase. So you got 4 different categories here. We got unprofitable growth companies, the headwind, profitable growth companies, which is neutral to tailwind. We got secular growth like AWS. They're insulated from the interest rates. And then you got the bigger picture plays like Coinbase. Um, that's if people become scared of what's going on in the market. So your job is not to predict which one wins. Our job is to understand what category we in, because we need to be able to position accordingly. If you are in an unprofitable growth stock, then you are fighting the headwind. You need to know that, accept that. Either have conviction that this company gonna overcome the headwind, or you need to redeploy the money somewhere else. You see what I'm saying? You need to move the money somewhere else. So I want to go over a few companies with y'all. Oh. We're gonna go over a few companies. What am I doing? Here we go. We're gonna talk about a few companies. Let me see if I can fix the way it looks. It'll be alright. It'll be alright. Alright, so we're gonna get into the specific stocks because the theory is nice. But we trade real stocks with real money. So I want y'all to take a look at these companies real quick. Broadcom. Look at the screen. That Broadcom. Let's pull up the chart on Broadcom real quick. Let's pull up the chart. Let's see what we got. All right, we're gonna look at Broadcom because, like I said, we trade stocks with real money. Broadcom is trading right now at $392. This is a semiconductor company. They make broadband infrastructure. They make the chips that go into networking equipment, servers, wireless systems, basically everything that requires wireless or wired data transmission. Okay? Broadcom is interested in a high rate environment. Broadcom is profitable. They generate billions of dollars in cash. They return that cash to shareholders through dividends and buybacks. They have no debt problems. They don't need to borrow money. In fact, when the rates go up, Broadcom can borrow money cheaper than a lot of competitors because they are credit worthy. The market trusts them. Now think about Broadcom's competitors. See what I'm saying? Think about Broadcom's competitors. Some of them are profitable, some of them not. The unprofitable ones, or the ones with thin margins, are now in a squeeze. They have to maintain R&D to stay relevant. They have to invest in manufacturing, but guess what? They need to borrow money to do that. The rates just went up. That cuts into their ability to invest. Over time, the profitable companies like Broadcom are going to pull further ahead. So from a technical standpoint, all right, from a technical standpoint, meaning the chart, Broadcom has been under pressure but found support. That's why, yes, it did fall pretty hard. It found support, as you can see. Okay, it found a floor, ladies and gentlemen. But yeah, nonetheless, it could go higher. It wants to go higher. It's bouncing. We want to watch this level. If it can stay above this $367 level, the next level of resistance was the previous level of support, which will be around $400, 405, around in that area, right? Yeah, we want to watch this area. If we can break above this level and hold it, yeah, we can see it push even higher. It wants to go higher. Now, here's how you think about trading this though. You're not trying to time it perfectly. You are literally riding the trend. If Broadcom stays above the white line, right? it's at, where is it at? What's this? Yeah, it's at 392. It's at 392 today. So if it can stay above these two levels of support and resistance, if it can stay above support at 367, we can take it to 406. If it doesn't break above 406 and stay above it, it can come back down. Okay, this is simple. This is a technical standpoint. We are not trying to time it perfectly. We ride the trend. If it breaks above, you get confirmation, meaning, we need to see volume increasing. We need to see the momentum is real. And then you enter a position. You put your stop loss below the support. Make it a small risk. Now, Broadcom is a stock that benefits from high rates because it's making money already. Its unprofitable competitors, broke ass competitors, they suffering. As long as the rates stay high, Broadcom has tailwind. Not a guarantee of profits, but a structural tailwind. Okay, let me talk about another company I'm looking at on my radar. We got Micron. MU. This is more interesting because there's a specific technical setup. If you look at the chart, Micron is up like Chuck, trading at around $1,043. It hit $1,110. Hit them a little bit over $1,100. All right, now I want y'all to watch Micron. It done already kind of took the fuck up. It's up over 4%. So Micron, they make memory chips. DARM. I'm gonna say it again. DRAM. DARAM. No spelling that, boy. DRAM. And then we got NAND. They make memory chips and other memory products. So every device, phones, computers, servers, data centers, they all need memory. So what's fascinating about Micron is in a consolidation pattern. The stock bounced around between roughly 1,000 and 1,100 for a minute. It's been choppy, right? So traders have been confused, but over the last few days, they have been forming what is called, this is like look like a cup and handle pattern. I also was seeing a bullish continuation triangle. Yeah. So this is an important pattern. When you get a strong uptrend, sometimes the stock pulls back and it consolidates and it bounces between a support level and a resistance level. The support, though, gets higher. The resistance gets lower. The range gets tighter. And it looked like a triangle on the chart. Eventually, that spring gonna have to uncoil. That eventually it's going to uncoil. That stock has to break out of the triangle. Okay, the pattern has predictive power. Yeah. Yeah, a lot of predictive power inside this pattern. So that's the edge. Based on historical analysis, the stock could go higher about 85% of the time when you see a pattern like that. And yeah, so you want to wait for confirmation, y'all. We're not just gonna jump in anywhere crazy. You want to wait for Micron to hold support, maybe bounce up to 1,070 on volume, and then I will enter. I'm taking it going back up to 1,100. But my real my stop, it'll go right below that, where would I say? Below support. If I'm wrong, I exit. But I'm targeting 1100, 1120. That's where I'm taking profit. The risk reward is good. I'm risking a little bit, but I'm gonna make a lot. That's a 3-to-1 ratio, a 3-to-1 reward. Risk to reward ratio. That's the kind of trade you take. But why am I trading Micron specifically? Because Micron is profitable. Do you understand what I'm saying? Micron make memory that everybody needs, and Micron has had supply constraints that are easing. As the supply eases, the demand stays strong. Micron's gross margins expand. That means more profit. And the higher rates actually help Micron because they squeezed a lot of the companies that wasn't making no money out of the market, reducing the supply and keeping the prices higher. See what I'm saying? I got another one. Hold on. Let's look at ASML. They make the machines that make the chips. You think of it this way. The chip manufacturers like Samsung, Taiwan Semiconductor, they all use ASML's machines to manufacture their chips. ASML is the equipment provider. ASML is the, remember I told y'all how the gold rush worked? This the picks and shovels right here. And during the gold rush, they started finding gold back in the day. The people that found gold wasn't the first to get rich. It was the ones who was selling them picks and shovels. This is them. This is a viable company. There's basically no competition for this company. They have a monopoly. If you a chip manufacturer and you want to make advanced chips, you buy ASML equipment. You don't have a choice. And as the chip demand stays strong, which it will because of AI and the cloud services and whatnot, and then we got computing evolution. Chip manufacturers keep buying ASML equipment. There's more demand for chips now, and that's just going to equal more demand for the chip making equipment. It's easy math, right? And then this company is profitable. They generate money right now, not just in the future. Right now, they have a real recurring revenue. And the high rates don't hurt ASML. ASML don't give two fucks about the interest rates. If anything, ASML can use the strong cash position to buy back stock or return cash to the shareholders, which also in return increases the value. So how do you trade ASML, y'all? Come on now. Let's make it make sense. How do we trade a company that's already up like this? We're not looking for a specific chart pattern like I just told y'all on Micron. We want to ride the secular trend. The chip equipment demand will stay strong, so we buy ASML at a decent price. And we hold it. We're not trying to day trade this shit. We holding it for months or years. Size it 2-3% of your portfolio. This is for educational purposes only. AWS, Amazon Web Services. Y'all have been talking about them for a minute. AWS is part of Amazon. Let me see. Yeah, AWS is part of Amazon. Y'all know that. But it's really its own business. They provide cloud computing infrastructure. Companies use AWS to host their applications, store their data, etc. AWS. They use it to run their operations. A lot of companies use AWS to run their operations, like Netflix. Netflix uses AWS. Spotify uses AWS. Tons of companies use AWS. Why is AWS, Amazon Web Services, valuable in a high rate environment? Because cloud adoption is secular. I've been telling y'all, look, y'all, the word of the day is secular. Go look it up. So you know what I'm saying. So it's not dependent on the rates. It's dependent on the fundamental shift that all companies are moving away from on-premise data centers to a cloud. Whether the rates are high or low, companies still need to make that shift. So when the rates are high, it may be even more important to move to cloud because AWS can provide scale, scale economy that lower the rates. So when the sell-off happened, AWS held strong. It didn't fall like the unprofitable growth stocks. And it did this because the business fundamentals are solid, the demand is structural, the company is profitable, they making money. I keep telling y'all. So if you own AWS, you don't have to panic sell it. This is a longer term hold. You're not trading it on daily moves. You're holding it because cloud infrastructure is the future. You're sized 2%. If it falls 30%, you down less than 1% of your portfolio. That's easy for you to manage, right? But now we're gonna talk about Coinbase too before I land this plane. This is a different one. This is a cryptocurrency exchange. Remember, and it's usually profitable when crypto is booming. And as you can see, it struggles. It struggles. It struggles when crypto is weak. It's a very volatile stock. It's speculative, but this is the interesting part. Jerome Warsh, I don't even know if his first name is Jerome, but I know his last name Warsh. Him being hawkish and inflation focused actually makes crypto more interesting to some people because people get scared whenever a lot of banks, you see what I'm saying, and inflation, they get scared off inflation alone. They want to hedge it. They want to make sure they got, plan B, C, D, etc. They want something outside the financial system, and crypto is that for them. Crypto is that hedge, right? So, Warsh being hawkish could on the flip side drive people toward crypto, right? The Fed is fighting inflation, but they might fail. I need insurance. I'm gonna buy Bitcoin face out. That's a real thesis. Like, that's a real macro bet. Coinbase benefits if that bet plays out. If crypto rallies up, Coinbase rallies up. Your position in Coinbase should be or could be 1 to 2% maximum because it's speculative. The upside is real, but the downside is real too. You should not put too much dip on that chip. All right, so I went over a few companies with y'all, and I gave you different reasons why I like to own them. Broadcom, making money. They have a competitive advantage. Micron, another company that's making money. They have supply-demand tailwind. ASML, they are in a monopoly position. They the boss. They the plug. They are also profitable. AWS, also profitable. Coinbase, this is a bigger bet on the crypto hedge. Either way it go, I gave you different reasons to own them, different sizing, different time frames. That's diversification, ladies and gentlemen. That's a real portfolio. Now, let's see where we at. Where we at? All right, so let's talk about position sizing. I want to teach you the thing that separates people who make money from people who lose money, right? So position sizing. I'm gonna be detailed about it because this is where a lot of people fuck up at. Excuse my French. Your maximum loss per trade is 1% of your account, not 2%, not 5%, 1%. That is the rule. Now, why am I telling y'all 1%? Right? I'm gonna show you the math. If you risk 1% per trade and you take 10 losing trades in a row, which happens, everyone loses, right? You down 10%. That's a hole that you can climb out of. You still in the game. You can still make money. But if you risk 5% per trade and you take 2 bad losing trades, you are now down 10%. You take 1 more and you down 15%. Now you're in a serious psychological ass whooping. Okay, you are desperate at this point, and then you're going to start making bad decisions and you will blow up an account. I'm here to help you. Okay, so 1% protects you from yourself. 1% keeps you in the game long enough to let your good trades pay off. So the first rule, 1% maximum loss per trade. That's your anchor. Everything else builds from that. Now, your position size depends on where your stop loss is, and your stop depends on the trade itself. Okay? See what I'm saying? Now, the second rule you might want to take, but before I go there, by taking smaller positions after losses, you are protecting yourself from yourself. You're acknowledging that your judgment is compromised and you're removing the ability to make it worse. Okay? I'm telling y'all, that's a gem right there. The second rule is after 2 losses in a row, your ass need to be paper trading only. If you lost on a stock or ETF, you took a smaller position and you lost again, you just took 2 losses in a row, don't trade with real money no more. Switch to paper trading. Track the trade, but not real money. Don't use real money. You see what I'm saying? Yeah, because after 2 losses in a row, your psychology is really compromised. You're in a loss aversion mode. You're desperate to recover. You can't trust your own judgment, and paper trading will force you to slow down. It'll help you take a break. You get to reset your emotional baseline, and you will remember how to lose with discipline. Only after you have taken several paper trading losses without feeling the urge to throw all your money at a revenge trade do you get to go back to real money. I know it sounds boring to a lot of y'all. I get it. I know. It sounds conservative. I get it. But this is what's going to keep you alive as a trader. A lot of y'all want to quit your day job. I don't see how you plan on doing that without doing this. Okay. Now, position sizing also depends on time frame. Different trades have different setups. If you day trading and your stop is tight, maybe 1% away from entry, and you can take a 3% position because your maximum loss is still small. If you swing trading, okay, and your stop is 5% away, you take a 2% position. If you holding it for weeks, your stop is at 10% away, you take a 1% position. So if you speculating on something like Coinbase, right, where you're not even sure where your stop loss should be, you take a 0.5% position or less. The logic that I want y'all to pay attention to out of everything I just said is constant. 1% max loss. Everything else you can adjust around that. All right, so I'm not going to spend too much time on that. We're going to talk about execution, because everything I taught you today is useless if you don't execute. This is what y'all need to do. You can chart every stock that we talked about: Broadcom, Micron, ASML, AWS, which is Amazon, and Coinbase. You're not trading it yet. You're just studying it. You pulling the charts. You drawing your support levels. You identifying resistance levels. You're looking at patterns. For Broadcom, where do the sellers come in at? That's what you want to ask yourself. For Micron, does the triangle, is there any chart pattern that I can see on Micron? For Amazon, what level would be a good entry? What's the stop? For Coinbase, if I'm going to speculate, where would I enter and where is my stop? You are doing the due diligence. You're understanding the structure. This takes 2 hours max. You could do it on Sunday night before the market open on Monday. The second thing you need to do, you can calculate your position size on paper. You could actually write these numbers down. Don't just think them. My account, $25,000. My maximum loss per trade is $250. Broadcom is at a certain level. I'm gonna put my stop loss right down here. That's a $4 risk, right? This is so I could buy 62 shares. That's a $10,000 deployment. That's 2.4% of my account. You feel me? Y'all, sometimes you need to write it down, like physically write it. This matters because when you're in the trade and emotions is running high, and you look at that paper, and you'll be able to remember your plan. Also, you should write down your rules before you trade. Not during, not after, before. I have a rule that I teach at IRONWORTH Trading, right? So if Broadcom falls to a certain level, I'm going to get out immediately. I write that number down. My rule is after I take a loss, my next position has to be 50% smaller. Meaning I just put, all right, if I put $200 on this trade and I lost it, my next one is got to be $100, 50% smaller. After 2 losses in a row, I'm paper trading. So these are going to protect you from yourself when you down 500 bucks and panicking, that piece of paper says, no, you follow the rule, okay? It takes the emotion out of it. Now, y'all should set up your stops before you enter the trade, not after. Come on now. Set the stop loss before you get in the trade. That's going to help you out. Yep, it's going to help you out. Now, the 15, let's see. You can watch your positions, but you don't overtrade them. You set them up. You let them work. You check them once a day. You don't look at your portfolio 50 times a day. You don't try to micromanage every 1% move. You literally should just let the setup play out. That's discipline, y'all. That is the boring part of trading, but I'm telling you, that's where the money is made. And action number 6, if your stop hits, you exit with zero emotion. You're not worried about it if your stop loss get hit. You say, let me wait and see if it bounce back, and then you exit. You ain't got to worry about saying shit like that. The stop loss was your rule. You followed the rules. That's it. And if your position hits your target, you take profit. You don't hold it. You don't hold it hoping for more. It's up $100 and you waiting for it to give you $200. Like, take the profit. You feel me? Take it. Take more next trade. But that is the framework. You chart, you calculate, you got rules, set up, monitor, execute, etc. So yeah, it's gonna separate good traders from bad traders. It's doing this alone. It's hard. It's really hard. But when Broadcom dropped 5% and you sitting there on a certain amount of money, your brain is screaming, sell everything. Like, I got my money into it. But when Micron rallied 8%, your brain is screaming, this shit finna go to 1,500. I'm gonna hold this forever. So your brain is designed by evolution to avoid pain and chase pleasure. In trading, that design is going to lose you a lot of money. You need somebody else, somebody to call you and say, you're breaking your own rules. That's not weakness. That's you being intelligent. That's knowing your own psychology and protecting yourself from it. Like a person who hires a personal trainer to come smack honey buns out their hand and shit. So this is not financial advice. But I just want to answer some of the questions that people been asking me from the community. Like, should I go ahead and sell my growth stocks? No. Panic selling is going to lock you in the losses at the worst time. I want you to think about it logically. You bought the stock at some price, but now it's down. If you panic sell, you are selling at the low. And that's the worst time to sell. You are locking in a maximum loss. Now, why would you want to do that? The real question is your thesis still intact? If you bought a company because you thought it was going to grow and become profitable and nothing has changed except the market fell, then this is a gift. This is a discount on something that you already wanted. You hold it and you add, actually. But if you bought a company that you now realize they need some cheap money to survive and the rates is going up indefinitely, then yes, get the fuck out of that trade. Get out of that company. Because that's a deliberate decision based on analysis, not panic. So how do you know Broadcom will go up? I don't know. That's why I use a stop loss. If Broadcom is going to go up, I make money. If it's going to go down, I get out with a small loss. I don't need to know the future, y'all. I just need to know my risk. Like, is Micron in the chart pattern that I was talking about? Because it's about 85% reliable historical. If it is, that's not me guaranteeing shit to you. That's a probability. Okay? And you're not risking your account on a probability. You risking 1%. You're taking the odds and sizing accordingly. Now, what if he changed his mind? This got worse. What if he changed his mind and he cut the rates next month? And everything I taught y'all changes too. If the rates drop, unprofitable growth companies becomes attractive again. Money flows back into the growth stocks. You adjust your positions. You don't hold losers hoping for salvation. You look at what's happening and you adopt. That's it, y'all. That's it. Your duty is not to predict the feds. Your duty is to position for the environment that exists. If the environment changes, you change. Somebody else said, what if I only got $5,000 to trade with? The percentages are the same. Your 1% maximum loss, $50. I know. Somebody said, how long do I hold these trades? Broadcom and ASML are medium term, let's say days to weeks, not necessarily years. This is a setup that should play out in weeks. Amazon, longer term. Coinbase, short term, high risk, high reward. But yeah, I'm not gonna leverage. I want to not now. Should I use leverage? No, not now. Not until you've proven you can make money without using leverage should you use leverage. Leverage is going to turn a 10% account loss into a 50% account loss, right? That's what y'all don't know. It takes small wins and turn them into big wins, yeah. But it also turns small losses into an account destroyer. You don't use the leverage, you build discipline first. You add the leverage later only if you've proven that you can manage the risk. Yeah, we went over interest rates staying high. We talked about chip companies. We talked about profitable companies versus unprofitable companies, Coinbase, repricing, position sizing, etc. And the hardest part is psychological. Your brain gonna fight you. Like, you gonna want to panic sell after everything we talked about, or you might want to hold the winners forever. Right? You will want a revenge trade after the losses, and that's not what you should do. That's where the accountability matters. Like, that's where the mentorship comes in. Not learning accountability. Okay. The link is in the description. You should book a mentor tour, a mentorship tour. Right? Let's build your plan and execute on it together, ladies and gentlemen. That's the stream. Thank you for watching. I'll see you in the next.